So before we take a look at the more advanced stuffs like indicators, Fibonacci and volume, we first need to learn how to identify the pattern. And step number one for the identification is that we want to see a strong impulsive move towards the downside. And later on in this video, I will show you guys an indicator that we can use to find the best moves here. But for now, let's just realize that we need to see a strong move down. And what the flag basically is that the flag is a move in the opposite direction of the impulsive move. So this right here is the flag, and what we're looking out for is a continuation to the downside. So this part right here is the flag, and what we usually do is that we draw two horizontal trend lines. To do this, you can simply click Ctrl C and Ctrl V to copy and get horizontal trend lines like this. So this right here is the flag, and the initial impulsive move, so this move right here, is what we call the flag pole. So we have the flag pole and we have the flag, and what we're looking out for here to confirm the pattern is that we want to see a break of the flag, or in other words, we want to see a breakout. Before taking a look at, entry points, target levels, and stop loss levels, I actually want to show you guys an indicator we can use here to find good and strong impulsive moves. And this is actually a special version of the MACD. So you go up here to the indicators tab, you search for, you want to open up the normal moving average convergence divergence indicator right here. It has to, for some reason, load for a while here. Then we want to go here to the settings tab, and I want to go to the inputs tab here and choose a fast length of 3, slow length of 10. Then we use SMA here as the oscillator type. Then we go here to the styles tab, and what we can do here is that we can actually uncheck the histogram, and we can also uncheck the signal line right here and only use the MACD line, because this can actually help us find these strong impulsive moves. When you have been trading for a while, you will be able to find these moves by only looking at the candles. But in the beginning, it can be very useful to use an indicator to sort of help you find these moves. And essentially what you're looking out for here is that you look at the level of the MACD. So you take a look at this point right here, basically the low of the impulsive move, and you want this low to preferably be much lower than the previous low. So you can see that the previous low is right here. We have a much lower low on the MACD, and this indicates that we have a strong momentum to the downside. So that is one thing you can look out for to find these good moves. And after you have found that move, we're looking out for this pullback right here. Another name for it is a retracement. But essentially what we want to see, as I said earlier, is that we want to see the price either going up here slightly against the direction of the initial move, and sometimes the flag will be sort of more horizontal like this. Another tool we can use is our Fibonacci tool. So we go up here, we press the Fib retracement, and to use the Fibonacci trading bear flags, we want to anchor the Fibonacci from the top of the impulsive move, and we drag it down here to the low. And most pullbacks will end somewhere in this middle area. You can see in between the 0.382 to 0.618 area, somewhere around there. However, I actually prefer the pullback to be, more something like this. So the pullback is ending somewhere here between the 0.382 to 0.05. This basically means that we have a pretty shallow pullback. And as I said earlier, sometimes the flags can be more horizontal. So sometimes you will have pullbacks that don't even reach the 0.382, but they can definitely still be tradable. But you can use the Fibonacci tool to, if the price, for example, reaches above the 0.618, then this is actually a bear flag I would avoid. So now then, where do we buy and where do we sell the bear flag? Well, we have two different methods here. The first one is the most simple one and the most common one, and that is to enter here on the breakout. So the breakout is essentially the candlestick that breaks out of the flag. You can see in this case we had a strong red candle that broke below, and this is a very clear entry point. In order to make the entry more significant, we can use yet another indicator, and that is the volume indicator. So in general, what we want to see is that during the impulsive move down, we want to see increasing volume. You can see the volume increased right here. During the pullback, we want the volume to decrease, and during the sort of break, we want the volume to increase. If we take a look at the individual volume of the breakout candle, you can see that this was actually not that good. You can see the volume was a tiny bit higher here than the volume during the pullback, but preferably you want to see even more volume. I like when I see the volume bar being, you know, twice as long or sometimes even longer than compared to the volume bars during the pullback. However, the good sign with this flag was that we actually saw increasing volume during the move down. So that is a good sign. If you're using the breakout method, it's very clear where we set our stop loss, or most traders will place their stop loss above the highest point of the flag. So you can see this right here is the highest point of the flag. I also like to leave some wiggle room here. So if the price comes up, it can test this high once again and fall, and we can still make money. So I like to leave a little bit of wiggle room right there. As for the target level, you may of course wonder, where do we set our target? Well, one very common method to use is that they basically measure the whole impulsive move down. So they take this measurement and measure here from the high. So this would give us a target, you can see all the way down here. And in this case, we did reach the target eventually, but it took quite some time. Another method to take targets is to use a fixed risk to reward ratio, such as you know, a 2-to-1. That is a very common and very simple risk to reward. But what you also can do, this is a bit more advanced, but you can actually use the price action to decide when to exit. So you can see that during this whole move down, we have only red candles and we see strong momentum and volume. But if you take a look at this price action right here, you can see that the price starts to go up, down, up, going sideways. You can also see that the volume goes down. So you can use these signs to essentially exit based on price action as well.